Hello, this is Manesh Patel from Ichimoku Trade. Today we're going to go for another trade review, and the reason why we're going through one of our trade reviews today is that we have September option expiry tomorrow, and I kind of want to go through one strategy that we've used, and I want to show you exactly how we translate it to options for entries and exactly what's happening with expiration tomorrow. Okay, so before we begin, let's go for a normal disclaimer to state this is for education use only. We're not soliciting you to buy or sell any particular instrument. If you do so, you're doing that at your own risk. All information is owned by EII Capital Group, cannot be copied or distributed without our permission. We are broker neutral, so we use a combination of Thinkorswim, TradeStation, and eSignal. Today we will be using Thinkorswim since we're dealing with options. Here's my contact details here, so if you have any questions, feel free to contact us. Okay, so now let's go to the charts. Remember, one of the things that we've talked about over and over since the beginning of this year is a concept called MTS, multiple time frame support resistances. And what we're doing in that scenario is we're finding institutional support resistances by making sure that the support for the day traders, swing traders, and long-term traders is exactly the same. Okay, so we have a scanner at Ichimoku Trade that does this finds for us, and what happened was on September 4th we had an opportunity here that was basically price was right here at MTF. Okay, however, we didn't really start here, and we really didn't look at this trade from here. We actually looked at it from that big volatile day that occurred. Volatility is going to be here to stay. Black swan events are here to stay. You're going to have a lot of little crazy price action that's going to happen within the day. The key is to sit there and take that information and not get caught up in the news or anything else and see exactly what's going on. Is it a game that was this downward movement here, or is it really going to sit there and follow through the next day to start making a move downward here? What we do is we look at the higher time frames, specifically the daily, weekly, monthly. We look for that big spikes like this, and we look to see what happens. During the day, this right here broke the green line and the red line support, went all the way down, and then came back and closed above the green and the red line. That was an indication here that Johnson & Johnson is still bullish. All this price action here really didn't mean anything because it closed above the support that it had broken. Okay, so that is very critical for us. So after that, we scanned the markets, and you probably saw me on Twitter looking for the swing trading time frames and the day trading time frames for this type of scenario. And what I was looking for is a multiple time frame support on both the swing trading time frames and also the long term. So in this example here, what you have is at this point right here, which is when we entered this option trade, was September 4th. On September 4th, price got to this green line support, which is a support for 26 bars for the daily time frame. It was right here. If you look at the weekly time frame here, at that level, that was also the red line support here for the weekly. So the same support on the daily is the same support on the weekly. Okay, and then we're going to go down to a swing trading time frame, and if you look here, this was, and this date and time, it was a future support that we're going to run into, and also the current support was just a couple of points below there. So since it was the support was only a couple of points below there, we noticed that it could sit there and bleep below that level here, which is kind of what we expected it to happen, and that's exactly what it did. It bleeped to that support, held it, and then kind of kept on going up. Reason why is the daily and the weekly supports were here. Okay, so we had an MTF level here at this point right here. So this is roughly when price was at 91.38. So we were looking at options to buy this, and we were looking for at least for it to come back up here to retest this high up here, which would be somewhere roughly about right here. Okay, whoops, wrong tool. Okay, now roughly about right here, and I'm just looking at the closing prices and the opening prices to there, and you could see it kind of got to our little target level here. The critical thing is that this we were going to use options, so we wanted to time it correctly. Okay, now due to the spike and all the craziness that took place, volatility was extremely high. Even after a day or two, or even a couple of days afterwards, volatility was still high. So you really couldn't sit there and buy a call option at all, because it would be very expensive. The only thing you could do was an option strategy that had a sell leg in there, because they were giving out good premium for the sell leg. So what we did was we looked at a vertical spread. Okay, now you have two options. You could look at a debit spread or a credit spread. To us, the best option, which gave us the best reward risk, was going to be a debit spread. Okay, so let me show you that debit spread here. And this is exactly the debit spread here that we basically put on in our student account. Okay, so in here, there's the Johnson & Johnson credit spread. You could see basically it was September 94.95 vertical debit spread here. And you could see from here our risk that we paid $25 per contract. Okay, our maximum reward would be roughly around $75 a contract here. Okay, so that was the risk to reward. So that was a 3-to-1 risk to reward that fit our profile to match. And if I click on here, you could actually show you the view of the trades. So you could see that these are physical trades that are taken, and you could see this is a live account here. So this is the 94 call leg here, where basically we bought the call leg 55 cents, and it's now worth $1.10, 12 fluctuating. And then there's a short leg of the entire vertical position here. Okay, and you could see it here. So you could see here, right here, we got about one more day of expiration. This thing's kind of flirting around 95, but if you look here, our maximum profit is going to be roughly right here. Okay, so at 95.07. So tomorrow, at the end of tomorrow, if this thing basically closes at 95.07, $95.07 or higher, we're going to have maximum profit on this vertical spread. If it closes exactly where it's at today, then guess what? It's not too bad. We'll sit there and walk away with about $58.77 profit. So this is a nice little vertical spread, low risk, high reward type of scenario, which is pretty much how you would sit there and make it in the options business. Okay, if you think about this, this is a 300% return based on the risk that we're taking. That's what you really need to have in order to be a successful option trader. If you have any questions, you could contact us here. Let me give you my contact details here. You could contact us here at any time. Thank you and have a good day.